What's up, it's your boy Sat with Stocks by Sat06, the channel with no face, just facts in 5. Today we're talking about something a lot of investors overlook because it doesn't sound flashy at first. ETFs. Now I know some people hear ETFs and instantly think slow money or boring investing. But the truth is, some of the smartest investors in the world build wealth using ETFs because they give you exposure, diversification, and long-term growth without needing to gamble on one single company. And today we're looking at 3 ETFs that I think investors should absolutely be paying attention to right now: SCHD, SMH, and DRAM. Now, before we jump in, hit that like button, subscribe to the channel, and join the family because we talk stocks, growth plays, sleeper investments, and ways to build long-term wealth. Let's get into it. First up is SCHD, the Schwab US Dividend Equity ETF. This is one of the most respected dividend ETFs on the market, and for good reason. SCHD focuses on high-quality companies that consistently pay dividends and have strong financials. We're talking about companies with solid cash flow, stable earnings, and long-term reliability. Now, what makes SCHD attractive is that you're not just hoping for stock appreciation, you're also getting paid while you hold it. That dividend income can be reinvested over time, and that's where compounding starts getting powerful. A lot of investors chase risky hype stocks, trying to double their money overnight. But SCHD is more about building sustainable wealth over years. And in uncertain markets, dividend-paying companies usually hold up better than speculative plays. So if you're someone looking for stability, passive income, and lower volatility, SCHD deserves attention. Next up is SMH, the Van Eck Semiconductor ETF. This one is completely different from SCHD because now we're stepping into high growth territory. SMH gives investors exposure to some of the biggest semiconductor companies in the world. And if you've been paying attention to the AI boom, you already know semiconductors are at the center of everything. Artificial intelligence, cloud computing, autonomous vehicles, gaming, robotics, all of it runs on chips. Companies in this ETF are helping power the future of technology. Instead of trying to pick one semiconductor winner, SMH spreads your exposure across the sector. That matters because even though companies like Nvidia get all the headlines, there are multiple semiconductor companies benefiting from AI demand. SMH allows investors to ride the overall trend instead of depending on one stock. And honestly, this ETF has been one of the strongest performing areas in tech because demand for advanced chips keeps growing. AI isn't slowing down, data centers aren't slowing down, and semiconductor demand isn't slowing down either. Now let's talk about DRAM, which is one of the more interesting ETFs people are sleeping on right now. DRAM focuses on next-generation memory and AI infrastructure companies. This is a much more aggressive, growth-focused ETF compared to SCHD. And even compared to SMH, this one targets a more specific niche. Memory technology is critical for AI systems because these advanced models require massive amounts of high-speed memory and storage. As AI expands globally, demand for memory infrastructure could explode. That's where DRAM becomes interesting. This is the type of ETF that could benefit heavily if AI infrastructure spending keeps accelerating over the next several years. Now, because it's more specialized, it also comes with higher risk. But higher risk can also mean higher upside potential. And this is why ETFs matter. Each one serves a different purpose. SCHD gives you stability and dividends. SMH gives you broad semiconductor exposure. DRAM gives you targeted AI infrastructure growth potential. Instead of putting all your money into one stock and hoping for the best, ETFs allow investors to spread risk while still participating in major market trends. That's one reason why so many long-term investors use ETFs as the foundation of their portfolios. Now, let me be clear. ETFs are not get-rich-tomorrow investments, but they can absolutely help people build wealth consistently over time. And honestly, consistency is what wins in investing. Too many people chase hype and ignore strategy. Meanwhile, disciplined investors quietly compound wealth year after year. That's why understanding ETFs is important, especially if you're trying to build a portfolio that can survive market volatility while still growing. So the question becomes, what kind of investor are you? Are you looking for stability and dividends like SCHD? Growth and semiconductor exposure like SMH? Or aggressive AI infrastructure potential like DRAM? Drop your favorite ETF in the comments because I want to hear what y'all are watching right now. And remember, none of this is financial advice. Always do your own research before investing. If you enjoyed this video, make sure you like, subscribe, and share the channel because we're building something special over here. It's your boy Sat, and I'll catch y'all in the next one.